Let's turn our attention back now to what's going on in the markets and the economy. For that, we're joined by Ann Sonders. She's the Vice President and Chief Investment Strategist at Charles Schwab. And Ann, I guess let's just kind of start with what you make of the market right now. We've gotten to all-time highs, which I think last time we spoke, I had been expecting, most people have been expecting we'd get here. So now we're here. We're seeing the rotation in the market the last few sessions. What do you make of the overall, I guess, health of the rally right now? I think as people have continued to doubt whether this will continue through the second half of the year.
Well, it's clearly been a narrow rally. If you look either at the S&P, you look at advanced decline, even if you incorporate all stocks, New York Stock Exchange advanced decline, whether you look at it for the NASDAQ, the AD has been rolling over as the indexes have hit an all-time high. And in the case of the S&P, you have less than 10% of stocks trading at 52-week highs, and it's less than 5% for the NASDAQ. So there's clearly been concentration. To your point, we had days like yesterday where I think there was an attempt at broadening out. You saw some of that rotation into some of the more classic cyclicals, be it energy, financials, industrials. But I think we're going to really need to see signs of sustainable economic growth to see any long-term traction in those areas. Absent that, I think the market will still be biased toward those big growth stocks that are not just sort of the favorites and have momentum behind them, but really represent the thrivers in this very unique economic cycle.
And then speaking of the economy, I think today is another perfect example of the weird economic world we're in. The housing market is on fire. There's no other way to say it, but yet we get a quite downbeat consumer confidence report that I think should be alarming to a lot of folks. How do you kind of see the economy right now, and that dual track? I mean, is that sustainable, that we can have a thriving housing market, we can have tech stocks doing well, but I think most consumers are going to be hurting if they're not already?
So it may be reflective of what I think could be a secular shift underway longer term, away from an economy so dominated by consumer spending and services, and a bit more driven by long-term investment. And I think that investment would be in areas like housing, continued investment in tech. About one of the only bright spots in an otherwise beleaguered business CapEx environment, even predating the pandemic, somewhat driven by the trade war, was in areas of technology, productivity, and efficiency. I think what the pandemic brought about is clear need for continued investments in healthcare and then possibly on infrastructure as well. That's not necessarily a bad thing. Those areas represent bigger growth drivers from an employment standpoint and may allow for a level of economic growth that is a bit higher than in the last cycle, where we had the longest economic expansion, but it was also by far the weakest in history. That doesn't mean we're not going to have, periods of pain in this transition. But if that's correct, that's not a bad shift for the economy to be making. It's just happening in a very condensed amount of time.
Listen, I want to go back to something that you mentioned before, and that's the fact that you think it's going to be a little bit of time, or we're going to have to see stronger economic data in order to see that sustainable shift towards cyclical. So that brings up the question, the valuations that we're seeing in a lot of these tech or consumer discretionary, however you want to characterize Apple, Microsoft, Google, Amazon up there, the companies that are leading this rally. Do you think the fundamentals, I guess, justify where they're trading today?
It's hard to say. I think valuation analysis is really tricky in this environment because of how unprecedented the weakness in the economy and the compression in earnings, how many companies simply withdrew guidance. I mean, there's no question that the fundamental strength of those companies is superior. Whether that's enough to justify those valuations, that's maybe a bit more of a stretch. I do think that we have the benefit of 0% interest rate policy as far as the eye can see. So the discount rate applied to that stream of earnings is significantly lower. And you could argue that justifies a higher plane of overall valuations. The key is whether earnings catch up to valuations in a reasonably short amount of time. If not, I think there's a risk of a bit of a pullback or some profit taking as we wait for earnings to maybe catch back up to those valuations. But on metrics like equity risk premium, the rule of 20, the Fed model, you could argue even those names in the market more broadly are not extremely overvalued versus, say, your traditional PE ratio.
And then just quickly thinking about the Fed, I mean, I think investors very quickly remembered what worked in the last decade. They said, let's just buy everything when the Fed stepped in March. Do you think that maybe there needs to be a rethink of what role the Fed plays? Will there be a rethink by investors of what role the Fed plays in setting expectations for the market? Jackson Hole's this week, and I think we're entering a very uncertain decade for what the Fed can do, now pinned to zero rates for the second time in 4 years.
But you're right, that narrative hasn't changed, and the boost to liquidity that the Fed provided in the last cycle and this cycle in a weak economic environment, in the absence of velocity of money, that liquidity has to go somewhere, and it's gone into asset prices. In this unique pandemic environment, it's been a more concentrated few in terms of stocks that are seen as not just beneficiaries of the current environment, but as I said, sort of thrivers in the kind of post-pandemic norm, whatever that looks like.
All right, Ann Sonders, Chief Investment Strategist at Charles Schwab. Always great to get your thoughts. Thanks for joining the program.
Thanks, Miles.